Today's topic, are we asking the right questions about the global economy? I'll get to three questions I want to answer in a little bit, but we're really living in a time unlike any other. The aftermath of the last 15 years has exposed cracks in the foundation of world order, of the global economy, and of the markets. Right now, we have a lot of negative sentiment, which is overshadowing some really significant opportunities that are reshaping industries and fostering a productivity boom that is critical to the global economy. And I think generative AI is a part of that. That's really, lighting the fire here. But we're going through tremendous change around the world, and we think it's time to really take a new look at fresh look at where you're positioned in the markets, and are you set up for what's happened in the past or where the world's going? I think the complexity of the environment is challenging the traditional investment thinking of the last 15 years, which has been based on near zero interest rates. And we're moving into what we're calling the next normal, which is the traditional levels of interest rates on a very different underlying economy. And I think that's really the challenge we're going to be faced with going forward. So there's plenty for investors to weigh as they're thinking about what's going on. We got growth, inflation, the wars, elections, finances, and more. I'm going to get into each of these in a bit, and then we'll get to the three questions. But growth has been mixed. We have some really positive things and some negative things going on. Obviously, the U.S. has done pretty well coming out of this. A lot of that is based on the policies that the U.S. has put out. On the other side of the world, Russia is doing well this year, coming out of it surprisingly well economically, given the sanctions and other issues. But I think they're borrowing from their future in doing that. But you have a very mixed picture. And then, as Mark, as you mentioned, China just came out with their 5% growth target. And I just got a note from one of our analysts, and it was Beijing targets 5% growth. Good luck is the title. And a lot of skepticism around China's growth target, but as the second largest economy, where are they going? We're going to touch on that in some detail in a minute. Since you're in the Middle East, I wanted to just share with you an IMF report that came out last week, where they were looking at growth in the region, and they showed really for the overall region, not bad, 3% growth roughly. The oil exporters doing a little bit better, the emerging market and middle income countries not doing as well, and the low income countries still feeling the pain of all the problems created by the big nations. But there's really four reasons why growth is slowing there. And these are the October projections versus the January projections. So pre-conflict and with the conflict. And the number one reason why growth has been taken down is obviously the conflict and not knowing how far it's going to expand and the uncertainty around that. I think the number two reason that was cited by the IMF was oil production cuts, which have been put through to help prop up the price of oil during this transition that we're going through. And that certainly is going to weigh on the revenues for several countries. The other issue, and I think this is not just a Middle East issue, it's a global issue, is the limited bandwidth that governments have to stimulate now is slowing down growth. And when you're subsidizing parts of the economy and you're running into financial difficulties, it becomes hard to do both, and something has to give. And usually it's growth that gives. And then because of the conflict, because of the inequality that exists all around the world, and because of some of the social stresses that come out of the conflict, you're starting to see increased social unrest, which is not great for growth either. So some challenges there. On the positive side, inflation is moving closer to targets, but it's not there yet. And we'll touch more on why central banks are being slower to move. I think one of the issues for politicians is we have a lot of elections coming up that they're missing is it's not inflation. Inflation is a point in time number, but it's the cost of living that's really on voters' minds. And this is one in the US, the Biden administration is struggling with, because they're touting how strong the economy is. They're touting how well inflation's come down. But what they're missing is the basket of everyday goods is up about 20%, and wages are not up that much for most people. So it's putting people in a bad spot. So I think these are some of the main issues that people are facing today and what's really on people's minds. And I think politicians are really focused on the wrong things, and that's why they're not capturing the voters as well as they'd like. So I want to touch on three questions pretty quickly as we go through. What's going on with growth in China? What are the problems and possibilities with that? Why are central banks so slow to cut rates? Because that's not what the market's hope is. And after the Fed announcement in January, where the dot plot said there may be 3 cuts this year, the market took that to 7 for reasons that we'll get into. And then, are you positioned for what lies ahead as opposed to what lies behind? So let's jump into it. I showed this chart a couple of weeks ago, and it's really looking back at China's growth prospects. And remember this slide when I show you another slide a little bit later on the US inflation. But when you're thinking about China's growth prospects, they are sliding down, and they're talking about 5%, but it really looks like they're going to do below that for this year. And I think there are a number of reasons why, but really the main part is their economy was very much built on real estate and housing for the domestic economy. And then the stock market, and both real estate and the stock market are down considerably. That's creating some challenges. But our view is it's not as sure a shot to overtake the US as the #1 economy. And it does have some characteristics going on right now that making it look like Japan did when Japan was supposed to overtake the US. And we know that they've struggled for 30 years to get back on a positive growth trajectory, which they seem to be moving towards now. China's growth challenges are a lot around debt, and they started the financial crisis with very low debt levels relative to other nations and have steadily seen that rise. And this is going to start to weigh on, it's weighing on the system now. It's part of the problem with the property, but it's part of the problem with housing as well. And this is going to really continue to be an issue for China until they can get it under control. And I think that's why the emphasis is on quality growth, not on growth at all costs, like they did in 2008, where they drove the global economy. Right now, they're looking to solve the problems with the fragility inside their own system before they worry about the rest of the world's. The other problem that China's having is capital flows are going the wrong way. They were the big beneficiaries for 30 years of capital flows coming in as manufacturing drove to the lowest cost producer, which was China. And now you're seeing that shift go the other way. They're seeing outflows. Some of that is policy driven. Some of that is just the geopolitical issues. And some of that is domestic. The way they've treated their domestic champions has CEOs thinking, who are foreign CEOs, am I going to make my future investments in China to attract that market? Or am I going to set up a business and worry about losing road? These are real issues. And when Jack Ma got thrown out or put to the sidelines the way he did, I think that raised a lot of eyebrows in the corner suites as to how are they going to play in China moving forward. The other issue is the trade barriers that have gone up. Some of them self-inflicted by China in terms of being too aggressive in their trade practices. Some came when we had President Trump move in. And if President Trump gets back in, I think the trade issues will get even worse, as he's calling for massive tariffs on imports from China, as well as a across the board 10% import tariff that goes out. So this is another area that's slowing things down. And where it was the world's manufacturer with China, that's not the same. So a lot of headwinds. Debt is a big part of it. And then the confidence that goes with all that, both from outside investors and from the domestic population, are really big issues that they're going to have to work through. I think the one thing that we all got wrong as a system, and I say the majority, and that certainly ARS is in that camp, we thought China last year was going to reopen more aggressively with a global reopening rather than stimulating their domestic economy, which made sense if you're a Chinese leader, but it didn't help the rest of the world. I think that's a big change. Their inward focus threw a lot of people off, and now we're stuck with, how does China get out of this problem, and what does it mean for the rest of the world? So I want to switch gears, because I think before I leave the China subject, let me just say that I also think China has a lot of tools to get out of the problems, but it won't be a quick turnaround. I think they're taking a lot of smart steps economically to get their house in order. But I think some of that might be too little too late. And I think if they really want to get their economy going better, we need to dial down the global conflict so that people can feel free to trade more openly. I think that's going to be one of the big issues that weighs on how China moves forward economically, is how liberal they are with trade and how open they are to the rest of the world. And do we get the global fragmentation that takes us too far away and makes it a fully bifurcated system or trifurcated global economy? So switching gears to central banks, because rate cuts are one of the big things on people's minds, and inflation is one of the big issues that we've had in mind. Why have central banks been slow? I think these 5 reasons are a big part of it. I want to touch on these a little bit. So the first one, and this goes back to the 70s, and the Fed has always been criticized from the 70s forward of that they got it wrong back then. And what did they get wrong? We had an oil crisis that caused a spike up in the first couple of years. And then the Fed took action, rates started coming down, but then we started to see other things kick in. And the other factors that kicked in were really guaranteed wage increases through the union contracts and through other contracts that were put through for the rest of the decade, regardless of what company profitability was. And that actually is part of what pushed a lot of corporations to seek lower cost labor outside the US and took the unions and took them from upwards of 30% of the workforce and brought them down to around 10% today. And I think that was a big part of what forced the shift over. And the Fed today is worried about a repeat of that. And this is the reason why. And it's not just the Fed, it's the ECB is worried about this as well. They believe that while wages growth is abated, it's not done yet. And the reason they say that in the EU, for example, is the German Auto Workers Union is up for negotiations right now. In the Indeed wage tracker for Europe, 40% of the eligible workers in that survey either were seeing their companies have wage increases being put through in the fourth quarter of last year or in the first half of this year. So a lot of those wage increases are not captured, and that does include the German auto workers who are looking for big wage increases. Fast forward to looking in the US, we have the Boeing Mechanics Union is one of the bigger unions in the US. They're looking for their wage increases coming through. And you also have the flight attendants in the US looking for wage increases, which are significant coming through as well. And those wage increases, it's not just the unions, but when you see wage increases of 4 to 20% being put out for other workers in other industries, it puts pressure on CEOs to raise them for their own industry as well. And I think that's why you're starting to see layoffs pick up and the need to increase productivity. So wage negotiations is another element. The other one in the US is the real question is, why should the Fed be cutting rates right now when the economy is doing as well as it is, when employment is at their mandate, which is full employment? We're at near record low unemployment in the US. You have rates where they've been at a range now where they're relatively in line with historic levels, certainly comfortable levels, although not comfortable compared to what we experienced for the past 15 years. And I think this is the adjustment process, the sticker shock that they have. But in the Fed's eyes, they're saying we're moving to a normal rate level. It's going to take an adjustment process, but the mandate for the Fed is maximum employment with steady, stable inflation, stable prices with reasonable growth. They're getting all three of those right now. Why would they be cutting into that when they could have problems coming in the future that would require them to cut rates? And if you remember, historically, the Fed would like to have about 4% available to cut rates to stimulate the economy if it hits in a recession. And it doesn't look like we're all that close to a recession right now either. So the better question is, why should the Fed be cutting rates right now? I think then why aren't they cutting rates as aggressively as the market would like? From the market side, the reason they want rate cuts to come is because they feel that earnings are going to be somewhat uneven, even though they're moving up, and they need the multiple expansion from lower rates that they were expecting for this year. So switching gears to, are you positioned for what lies ahead? And I saw this quote from Mohamed El-Erian where he's talking about that we're just getting started on generative AI and what that means and its drivers. They're moving at a pace that we're not used to. And I'm reminded of a quote from Justin Trudeau from Canada, where he said, the rate of change has never been this great and will never be this slow again. And I think what generative AI is going to do and the way that that gets adopted and brought in is going to create a rate of change that will be phenomenal, but it will be disruptive as well. And there'll be good and bad that comes out of that. So we need to get it under control the right way, but this is where the opportunities are going to come from. And as he says, it is at the top of the agenda for executives everywhere. So where do we find good investments? They're in the areas, obviously, semis, cloud, and anything that's going to improve productivity to offset the labor cost increases and other cost increases that are coming through is going to be key. We think of technology not as a sector anymore, but a way companies are dealing with the problems that they're living with every day. And we think that technology is becoming more ingrained into every other industry, so that you really shouldn't be looking at it as a sector as much as a way we're improving productivity. We like the industrial complex, the reindustrialization that's going on. As a lot of that's policy driven, and the U.S. has been as aggressive as anyone in doing that. It's one of the probably the areas that the Biden administration would get the most credit for, of the policies that they have around the Inflation Reduction Act, the Infrastructure Act, the National Defense Authorization Act, the CHIPS and Science Act are really driving a lot of the growth that we have in the new investments into the U.S. And it's putting other nations at a competitive disadvantage, particularly Europe, who doesn't have that kind of industrial policy that is driving it. And this is where the bandwidth of countries' finances comes into play. We could put $4 trillion, we'll have the bill come due later on, but we can see the growth and we can see how it's transforming industries and positioning us better for climate change and national security. I think one of the big areas and one of the hardest areas to play, and one of the biggest surprises, has been how commodities have performed. And I think a lot of that's tied to how the emerging markets have performed as well, because commodities and emerging markets seem to go hand in hand in their performance. And I think we've been expecting a bigger push up in commodity prices, but the slowness and China's being more introverted in terms of their stimulus rather than global is a big part of that. But we still think there's a big opportunity in these areas, rare earth, steel, and copper, which is selling for really low valuations with big needs. And if we move to a fragmented global system, the way we believe we are very aggressively moving there, that's going to become a bigger area for the West to have secure the supplies that they need. So we still see big opportunities there. We love the energy transition, but we think it's going to take a lot longer and require you being on both sides of that transition. We think this is going to be a big place for capital to come, but it's also going to be a big place where capital can be lost. So you have to be very specific about what you're investing in there. And then healthcare is one of our favorite opportunities today, because you can see already how generative AI is changing outcomes, how advanced technologies are allowing us to lower costs and improve the outcomes at a dramatic rate. And that for the US is very important. With our healthcare is about 15% of GDP, almost twice what it is for most other developed nations. And getting that down allows us to take that money and put it into other more productive spend that our country needs as well. We also think this is an environment where you want to focus on quality and be in the quality companies. People are going to be scrambling for capital, and if you're highly indebted, it's going to be a tough slog to not only pay off your debts, but make the investments you need to make to get the productivity increases and get your generative AI in place. In terms of markets, we favor the US over the rest of the world. There are some other nations, some of the Southeast Asian nations, that are big beneficiaries of capital flowing and manufacturing shifting out of China. But when we look at the world, just look at the difference between the US and European markets in this one slide. This was in the FT yesterday, and they look at Microsoft compared to the FTSE in terms of market capitalization, and NVIDIA compared to the DAX. And it just shows you the difference in scale of the markets and the economies and the fragmentation that's going on in Europe, and how I think that's holding them back from realizing the potential that Europe has. I understand the difficulties of getting to a more common fiscal system, a more common market system, but you can just see the potential difference between the areas. And I would say that we're getting increasingly cautious about the mega seven. We think they're running into some things. I would also say I highlighted a couple of weeks ago what Goldman's termed the granolas out of Europe, which are firms like Glaxo and AstraZeneca, some of the healthcare names like Novo Nordisk that are doing really well. You have ASML and the Lambs that are also doing well. So there are real champions there that have to be better supported to do well, but they're also stuck between the fight between China and the U.S. in terms of their markets and how do they play in both. So it's going to be increasingly complex, but we think the industrial policies, the rule of law, the innovation, and the like favor the U.S. in this environment. And we also think the valuations are pretty attractive, even though there is big valuation differences between the overall markets. We think what's missing in those valuations is where the growth is coming from. We think the U.S. is much better positioned for that. I think industrial policy is a big part of it. And I'm almost finished. I'll go through the slides pretty quickly, but industrial policy is driving capital flows to the U.S. You can see this just from construction spending, which a lot of that is the CHIPS and Science Act and what we're doing with fabs going up in the U.S. and what it's doing for the Midwest and for the Southwest in the U.S., as well as the Southeast, which are all big beneficiaries of that spending coming through and a lot of foreign capital coming back to the U.S., which is creating new jobs and new opportunities here. And that's shown through in U.S. corporate profits. And just look at how we've done since the pandemic hit. And you've seen one of the biggest moves in corporate profits moving from 08, where we were around 1.7, 1.8 trillion, to now we're closing in on $3.6 trillion of pre-tax profits, moving up very aggressively since the pandemic hit. So again, uneven sharing of the blessings there. As we know, the FANGs are sucking up most of that, but that's same in most economies, as well as there's bigger concentration in other stock markets, with the top 10 being so dominant. I think there's not that many stocks. There aren't 500 stocks in a lot of the indices in other countries as well. The last thing I'll share with you is your position for the next election. And this is a slide showing where it's Super Tuesday today. It clearly looks like it'll be Biden and Trump. The no labels part is discussing whether they're going to come out with a candidate this week. Haley did as good as she could, but Trump has captivated a base that is really frustrated with the world. But the real point about this is whether it's a Democratic or a Republican administration, you have two very different outcomes. As I mentioned, Trump's talking about big tariffs and, drill baby drill and defense, and Biden is focused on green energy and healthcare and childcare. So very different outcomes, and you have to think how you're positioning for that moving forward. So we see big changes going on around the world. The cost of living one, I think, is one that politicians should focus on more and policymakers should focus on more, because I don't think they'll get reelected if they don't. I think global fragmentation is going to continue to get worse, but the reindustrialization is where the big opportunities are for many. I think it's going to create a very uneven economy for a lot of companies. So this isn't an environment where you want to own the market. You want to own businesses. Whether it's private or public doesn't matter either. I think you want to be in the spaces, in the segments of the economy that are going to attract capital and avoid the ones that it's flowing away from. And unfortunately, in this environment, a lot of that has to go to the balance sheets of those industries and sectors, and also what support they're getting from governments. I think we'll see more easing of financial conditions, but not to the level of market expectations. I think the Fed will be cutting 2 or 3 times this year. I don't think Powell particularly cares about the election, because he's already been told by one guy he won't get reappointed if Trump wins. And I think Biden would be happy if he did cut rates. So I don't think it really matters from how Powell sees the world. I don't think he's swayed by that much at all. I think he'll move on to whatever happens after if he's not the Fed chair. I think you also want to follow the money and remember we're living in what could be one of the most amazing periods of innovation I think the world has ever seen, and the next couple of years will be even greater than that. So Mark, I'll stop there and open it up for discussion.
Thank you, Stephen. Questions, comments?
I have a question about real estate. That was very informative and a wonderful overview and exciting to hear about. But what's going to happen with real estate, with the office sector and then the residential sector and hospitality, and there's a lot of old warehouse space that needs to be renovated, that kind of thing.
Yeah, I think I'm no expert on real estate, so we can get one of the experts in to talk about it. But my sense is that the real estate problems of today, which are big, will not be the problems of what we had in 08 with the housing in the US. I think on the terms of scale, it's much smaller than the housing for the US anyway. I also think the conversion of commercial to residential in cities is going to be very difficult if it can be done at all and very expensive. I think you'll see probably more tear downs than you will conversions from what I understand, but I'll let others talk about that. I would say that if you really want to get a sense of where the real estate market's going, look at what BlackRock and Brookfield are doing. And I think you're seeing them start to buy big developments from some of the builders where they're buying 5 blocks of 5,000 homes at a pop, thinking about the affordable housing going forward, and also clearing the mechanisms that the home builders can move those inventories off their books onto BlackRock or BAM's books, and then allowing them to refill and keep the housing going that they need, because we do have some affordable housing shortages that they need to address. So I think there's a lot going on there. I think the logistics space is one that you'll see people continue to look at as well. But I think it's going to be a challenging area. And I don't think it can afford much higher rates, but I don't think they should expect much lower rates in the US either. I did see a question about Trump's choice for vice presidents. I don't know who that would be. I wouldn't make a prediction on it, but what I would say is for his offices and stuff, or for his cabinet, I would say don't expect a lot of Washington insiders like you had the last time, because they blocked him from doing a lot of the things that he wanted to do because they thought it was bad policy. I think he's going to look for more yes men who allow him to do more with executive orders and avoid having to go to Congress as much to get into the fights that he doesn't want to be stopped doing for what he wants to do if he was elected. So I think that's the way you should look at it. I think it'll be more people who will go along with whatever Trump says rather than people who are doing what's right. Not that the two might not overlap at certain points in time.
Hey, Stephen, do you have any policy prescriptions for how to address the cost of living issue? I know you try to differentiate between cost of living and inflation. I do see them as linked, but obviously the Fed is limited to how much they can keep rates higher to try to choke off the inflation. But as you've made the distinction between cost of living and inflation, what's your policy prescription for trying to address that issue?
There isn't one that they can come up with. They talked about the what did they call this? They're having a SWAT team to go after corporations that are gouging. That's not how they're going to get there. What happens, and this is a fact of life, is when you have inflation, the inflation numbers are point in time numbers, so that comes down. But the increase that you experienced usually stays with you. That becomes your cost of living. So it really becomes it's a growth issue. You have to grow faster than the cost of living, and you have to get wages growing at that level, and that's going to be hard to do if they don't start getting us to be a more efficient system. So I think that they have a real issue here, and I think politicians. I think the answer for the administrations is they have to acknowledge it so that the voters don't feel like you're not paying attention to them, and you have to explain it better instead of crowing about how great the economy is when people are feeling completely the opposite. You have to actually explain to them why and what you're going to do to get the growth back on track.
Ana Blanco? Or no, sorry, Joe, you had your hand up. Sorry, excuse me.
No, go ahead, Joe.
Yeah, Stephen, 2 questions really. You familiar with Peter Zehan's work, and have you seen his latest comments about how he woke up yesterday or today to a bunch of data that says that most of Europe's actually in a recession?
Yeah, actually, that's one of the most fascinating things. I don't know his work, Joe, but I actually was going to start with this, but it is one of the more confounding things we've seen in our lifetimes is you have markets around the world hitting record highs and economies in recessions or close to recessions. It is the opposite of what you would ever expect to see. And you look at Japan, for example, or Germany, or the European markets, they're all on the brink of real issues. China's another one. And you look at their markets, China's markets just starting to turn up a little bit. It's down a lot, but Japanese market new highs, European markets new highs, and their economies are not doing as well. And that's one of the more confounding things that we're seeing today going on. And I think that you got to be careful in all the markets today, public and private, for that one.
And one quick question, any comments on gold? And I'm out.
Yeah. Fascinating to see it, another record high. And when you look at the performance of gold relative to stocks going back to 2000, it is one of the best performing asset classes in the world over that time, and everyone hates it. I suspect that a lot of there's a lot of gold buying that's money trying to move out of jurisdictions. You also saw some central bank buying over the last year as well to deal with sanctions. So I think there's a number of factors that are pushing it up. And it's fascinating that it's hitting new highs at the same time Bitcoin and stocks are hitting new highs. So I don't know why, but it is a fascinating thing to watch. And maybe it's because people are really not focused on it as much because of what's going on with Bitcoin and other areas. So it's a crazy one, but I don't have a good answer for it. Thanks, Joe. Adam?
Yes, Stephen, fascinating presentation. Thank you. My question is about the inflation and cost of living. You said they're two separate, inflation is a point in time. Isn't the cost of living also an accumulation of that inflation over time?
Yes, that's why they're connected, is the inflation you have this year and then add to next year's inflation becomes the increase in your cost of living in most cases. It doesn't match, but that's actually what happens. And inflation can come down, but the cost of goods don't necessarily. Right. You look at housing, you look at anything. And what's the dollar worth from when the Fed was started? You know, it's like worth probably 8 cents now. So your buying power is declining, where inflation is really just what your buying power is, a measurement in time. And that's why people get so frustrated when the administration is saying everything's great. And you go to the stores and, you know, you can't afford a meal. You know, that's really where the disconnect's coming from. So the governments have to be better at explaining the difference between the two and not touting things that don't mean anything to the population when they're sitting there saying, that's not how my life works.
Now,
I think that's,
Thank you.
would that prescription also be wage increases that you talked about that are coming up? But then again, that also adds fuel to the inflation, right?
yeah, that's where productivity is really going to be the key, is can you produce more without increasing the cost? And ironically, when inflation rose a lot the last couple of years, productivity came down. The pandemic brought productivity down, even though we feel we were all more productive and all that. We all say with Zoom, we became so much more productive. Companies are dealing with this every day with their employees who don't want to go back to the office 3 or 4 days a week because they say how productive they were at home. And all the numbers show that productivity had come down during the pandemic, not gone up. So I think you do need to increase productivity. And that is going to be the way companies are going to deal with this, is they're going to be laying off people and doing more with fewer people and doing more with technology. That will slow the rate of inflation if it goes right, but it won't necessarily, and then that will translate into slowing the cost of living. But what's happened the last couple of years is in the system. It'll be very hard to get out later on.
Thank you, Stephen.
You're welcome.
Any more questions or comments?
Have you seen the news about UK new bill that Jeremy Hunt will propose with regards to smaller pension funds that are not very transparent and active? They will be probably closing down or getting acquired by bigger ones, and in order to bring more investments back to UK rather than what was outside. And another one was also that bill that was passed for angel investor threshold to move from 100K up to 170K, which automatically pushed out lots of women angel investors as well. So And Jeremy luckily is also reversing that one back, because that was just a big oversight and problem actually that UK would be facing. So at least that's positive news. But that can be passed before the election comes in. So that's another waiting time.
Yeah, pensions are a big issue, and they're going to become I think, even bigger issue. And there's talk in the US now where more companies are looking to go back to defined benefit plans. And that has all sorts of implications. But you've also seen a lot of pensions sell to insurance companies and the like. And I think that trend's going to continue to pick up as well. I think that's going to be an area that is going to be somewhat challenging, because people want better pension benefits, they want better social safety nets, and they don't want to work longer for it. So the math doesn't work on a lot of these things. I mentioned a couple of years ago, I saw statistics on one of the largest pension plans in Canada. They had the average time working in the system dropped by 9 years. Their average time taking benefits went up something like 7 years. And the number of people working in the system dropped considerably. So you have fewer people paying in, more people on benefits longer, and the math just doesn't work for those systems, and which require more contributions from the government in this case to do that. And that becomes a problem too. So I think you're seeing the strains of that coming through. And I think governments and corporations are going to be looking at their pension plans, and you may see a return to some defined benefit plans in some places and some eliminations of them in others. And I think it's going to be fascinating to see how that evolves. But nobody wants to go for the longer retirement age either.
Or that could be your universal income.
Well, that could be what comes too from a lot of the tech things coming, which would be, you still have to figure out how to pay for that, Duncan.
No, I don't know. Somebody seemed to
the robots. Right. So,
Stephen, quick question on
Michael, Hammer, you have a question? You have your hand up?
Yes. Stephen, one of your slides showed China's increased debt. How much of that is internal? How much of that is external?
Let me see if I can pull it up. And
Stephen, carry on. I'll be right back.
Okay, let's take a look at this. There we go. I would say a lot of their debt. I think a lot of their debt is internal, but I don't have the statistics, Michael. I would think it's more and more internal than external, because I think a lot of people have been pulling back from that in recent years. But I don't have the number on that one.
Okay, thanks.
A lot of it is in their real estate. A lot of it is real estate related, though, and that is a big part of the challenge there. And it's twice too. It's on the commercial real estate, and then it's on the household, all the properties that they were building too. So it's a real issue. It's going to be an issue for them for a long time, I believe. And in the US, our debt is growing about $1 trillion every 70 days. So not a great setup. I don't know if anyone on the call has a better answer for Michael on if they know the internal debt versus external debt for China.
Stephen, another China-related question. You mentioned that the forecast for growth is around 5%. Now, these are all official government statistics, which I assume are a little inflated. Any feel on what the real growth rate in China is or will be?
No, if I had to guess, they'll probably be around 4%, something like that. They're not as tough as many challenges as they have right now. I think people better need to be careful about getting too negative on China, because they have so much going on, so much to offer that is in their control. And when you're an autocratic nation, you can get a lot of stuff done pretty fast if you need to. And I also think they have some very pragmatic thinkers there that can help offset some of the ideological thinking that will put them on the right track. So I would just say they have real issues, but I would be careful about being too negative. And I think there are the same opportunities or similar opportunities in China as there are elsewhere in the favored areas we're looking for, whether it's in AI or whether it's in defense spending. They've just increased their defense spending as 7.2% of GDP. So there's capital flowing to very targeted areas, and the government's told you those areas. I'd say, as always, invest with the government, not against them in China. And you can be successful there. So, sorry, Roger. I think that's the best I can do for you there.
Thanks,
Stephen. Yeah, Stephen, back to your pension comment. Did you see this morning that there's 3 cities in England declaring bankruptcy?
I did not, but it's going to bankrupt. Well, we have plenty that should be here, right, Joe? And Illinois, we have a state that's so far under, and California's not doing all that great on their pensions either. So yeah, we have a real issue here, and I think they're going to transfer that issue to the insurance industry. How that plays out, I'm not sure, because we've seen that with a lot of them doing that already, selling their pensions out. So it is an issue that's going to come to a head. Well, Mark's still on, so I can't see the screen here.
Just a fun fact. I was comparing some costs of living between UK, London life and Valencian side of Spain, and it's 54% lower cost to live in southern Spanish region in comparison to London. 54%. It's just crazy.